Hi everyone. Welcome to my channel InfoCraze. Today, we are diving into a crucial topic for finance managers: financial management. Whether you are a seasoned professional or just starting out in the field of finance, these insights will be helpful in the corporate sector, where every decision carries weight and every dollar counts. In today's fast-paced business environment, the art of financial management isn't just a skill. It's the compass guiding companies through ever-changing market factors. Before we proceed, request you to subscribe to my channel to have easy access to my future videos. Now, let's get started. Let's start with the basic question. What is financial management? Before we define financial management, let us consider a simple scenario. Imagine, John is an entrepreneur who wants to start a new business venture. In order to start the new business, John may have to go through the following stages of decision making. Stage 1. Decide on the assets to be bought. Stage 2. Determine the investment required for buying the assets. Stage 3. Decide on the working capital requirement for business operations. Stage 4. Decide on the sources of fund for financing assets and working capital requirement. Thus, financial management refers to the efficient acquisition of funds, that is, financing and efficient allocation or usage of funds, which means investment in assets, working capital, etc., with an objective to make profit and take decisions on distribution of the same. Thus, in broad sense, three core financial decisions are taken by the financial management team of any business enterprise. These are: 1. Financing decision, that is, where to get the money from. 2. Investment decision, that is, where to invest the money. And 3. Dividend decision, that is, how much surplus money to be retained or distributed to shareholders. Thus, financing decision will include matters related to fund procurement, whether to opt for debt, that is borrowed funds, or for equity, that is, owners' funds. The investment decision will involve decision on capital budgeting, which is long-term investment, and working capital, which involves short-term expenses. Lastly, the dividend decision will decide on profit distribution as dividends and the retained earning. Having understood the core functions of financial management, let's now look at the definition of financial management. Financial management may be defined as the systematic process of planning, organizing, directing, and controlling the financial activities of a company to achieve the organization's goals and objectives effectively. Financial management in a company covers various objectives aimed at ensuring the financial health and stability of the organization. Two main objectives of financial management are: 1. Profit maximization. 2. Wealth maximization. Traditionally, profit maximization is often seen as the primary objective of financial management. This means, the finance manager has to take decisions in such a manner that the profits of the company are maximized. This involves increasing revenues, while minimizing costs and optimizing operational efficiency to generate the highest possible profit in the short term. Wealth maximization focuses on increasing the long-term wealth of the company's shareholders by enhancing the value of the company's shares over a period of time. Wealth maximization considers the impact of decisions on the company's stock price and overall shareholder value. Thus, while profit maximization is primarily concerned with short-term gains, wealth maximization considers the sustainability and growth of the company's value over the long term. Apart from these two main objectives, financial management also got several other objectives. Some of the important ones are: optimal resource utilization. Financial management aims to ensure that the company's resources, including capital and assets, are utilized efficiently and effectively to generate maximum returns. Then we have liquidity management. Maintaining an optimal level of liquidity is crucial to meet short-term obligations and unexpected expenses. Financial management involves managing cash flow, maintaining adequate working capital, and ensuring that the company can meet its day-to-day financial needs. Next is risk management. Financial managers must identify, assess, and mitigate various financial risks faced by the company, such as market risk, credit risk, liquidity risk, and operational risk. The objective is to minimize the impact of these risks on the company's financial performance and stability. Next one is capital budgeting. This involves making investment decisions regarding long-term assets and projects. Financial managers evaluate potential investments based on their expected returns and risks to allocate capital to projects that offer the highest value to the company. Then we have capital structure management. Financial management aims to determine the optimal mix of debt and equity financing to minimize the cost of capital while maximizing shareholder value. This involves evaluating various financing options and maintaining an appropriate balance between debt and equity. Last one we have here is legal and regulatory compliance. Financial managers must ensure that the company complies with all applicable legal and regulatory requirements regarding financial reporting, taxation, and corporate governance. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. As financial management is a vast subject, I can make further videos on this topic for covering other aspects. If you want me to elaborate this topic further, please put your remarks in the comments section. You can also watch my other videos on job interview tips for finance manager and accounting ratios. Thanks for watching.